Hello, all my mortgage fanatics out there. Today, we're going to talk about the 1% down conventional financing and the 3% down conventional financing versus FHA. On my other videos, we talked about the groundbreaking Fannie Mae 1% down. It does have some income limitations that can be restrictive in some areas. It's 50% of the AMI, which is the adjusted mean income of that area. You have to look that up in the Fannie Mae lookup tool. It depends on the property zip code of where you're buying. Not where you live, but the property zip code in the area, the geocode of where you're buying will be the qualifying down payment. That being said, let's review FHA and conventional. FHA is a good product for people that have bruised credit. So if you've got 640 credit score, 620 FICO score, 660, and when you want to do a minimal down payment, it's probably a pretty good product. You get the higher credit scores. Conventional beats in every aspect. One is there's a 1.75% upfront mortgage insurance premium. So what does that translate into? That comes out to a upfront mortgage insurance on $500,000. You're looking at $8,750 that you have to pay to FHA to get that loan. That's just a fee that you pay that goes on top of your loan, and it's financed, but you're going to pay that back. So it's financed, so you pay back 2 times. So that's just the fee that's gone. You don't have that with conventional. 1.75% up front. The second thing is they have 0.55% monthly mortgage insurance. Now with conventional mortgage insurance, like for example, a $500,000 loan, you're looking at a 780 FICO score, you're looking at $63 a month, 5% down. With 3.5% down, you're looking at $239 a month. And that stays on for the life of the loan. The conventional mortgage insurance can drop off when you hit 80% loan to value. So the property goes up and you pay your mortgage down and you pay the mortgage for 24 months and it has been on time. They will remove that mortgage insurance. That FHA, it's on there for life. I mean, there's nothing you can do about it. You're going to be paying that FHA mortgage insurance. And now if you look at $239 times 360, that's $86,000 in mortgage insurance. That's on top of the $8,750 you'd pay up front. So think about that. A lot of people get pushed towards FHA. One of the reasons is they changed their pricing. FHA should be about 3/4 of a point lower than conventional if the margins are the same. Most people move the margins up, just like VA. I talk about that in my other loans. The American finance system, if there's a more profitable product, they'll actually gouge you on the profit. They'll make 2 and 3 times more and give you a higher rate than you deserve. Just because it looks better, it should be about 3/4 of a point lower. So if the conventional 6%, FHA should be 5.25. I mean, it can move a little bit. That's a good rule of thumb that it's that different. That's where my pricing is. I make the same. Most lenders, and when I mean most, 99%, will make more profit on FHA. They also make more profit on VA. That's not something we believe in. We don't believe in taking somebody's service from their as a veteran and stealing that low rate and putting that money in their pocket. At the same time, FHA, these people pay a huge amount of mortgage insurance. Upfront mortgage insurance, 1.75% upfront on $500,000. That's $8,750. Then they pay another $239 per month in mortgage insurance. That insurance is what lowers the rate because it's a lower risk to the person holding the mortgage. Because if you default, those insurances pay. Because of that, the rate should be lower. They don't do that. They move the rate up and they make more money and they make you pay that over time. And it can be hundreds of thousands of dollars. So I can go through the numbers with you. As they say, the numbers don't lie. It's right there. And people can say, oh, that's not true. Well, let's look at the numbers. Because I can break it down and I can show you 100% those numbers are true. I've been through this. The only reason most people don't talk about it is they're making more money. I'm not. So there's the difference in on our pricing structure. Pricing structure is set by the owner. I'm the owner here. I set the pricing. I make it the same across the board. So I'm not doing anything better on a absolute level, but on a comparative level, I'm way better than these other lenders. They make it easy for me. Their greed is and I kind of enjoy exposing their greed. If you're going to gouge somebody who paid mortgage insurance for FHA, hey, maybe we should look at the numbers and see what you did. If you're going to gouge somebody who had insurance placed and paid for by the Veterans Association on the VA loan, and they deserve a lower rate, and you tripled your profit, maybe we should talk about this. Maybe we should show the veterans this. So give me a call. We can open up a conversation. If you have more questions, leave some comments below. Be happy to answer anything you have, and we'll talk to you soon. Thanks.